Hello, class, and welcome to the second video lecture for chapter 2. So in lecture 1, we went over some principles, assumptions, and stuff that's going to help us when we're analyzing transactions. Then we actually analyzed some transactions and saw what it was doing to the accounting equation. What was happening with our assets, what was happening with our liabilities, stuff like that. Okay. When we get in this second half of this chapter, we are going to start looking at, what actually happens when we go to report stuff. All right, so give me a second here and let me share my screen here. All right, so as an accounting system, we are going to use what is called double entry accounting. This has been around since the late 1800s, which means that whenever something happens, a financial transaction occurs, and we go to record it, we need to make an entry. Okay, we're actually going to need to make a double entry. So that means we're going to have to affect 2 or more accounts. So an account, it's a record of increases or decreases in each of the basic elements of the financial statements. When we were analyzing and identifying things, so like cash is an account. We can analyze when cash goes up or down. Okay, we have accounts receivable, our accounts payable, common stock, whatever we identify as the component of the accounting equation, we are going to call that an account. The list of accounts by employee is called its chart of accounts. Okay, so just a knowledge check here. A company will receive $5,000 for 101 year subscriptions on July 1st. This transaction would what? Kind of going back to analyzing transactions. Would it increase accounts payable? You need to know accounts payable means that we owe somebody $5,000. No. Increase prepaid expenses. Prepaid expense is money the company has paid out for future expenses that they're going to incur. Well, this isn't that either because they received $5,000. Increase in unearned revenue for $5,000. This is going to be your answer. What happens in this transaction? Well, cash increases the asset by $5,000. That also creates a liability. We now owe 100 subscriptions. Okay. We cannot recognize it as revenue yet because of the revenue recognition principle. So instead, we make it unearned revenue, which is a liability. All right. So I was talking about chart of accounts. These are the typical accounts that we're going to have. Okay. We kind of already went through them when we were creating our balance sheet. Okay, everything that we would put onto our balance sheet or our income statement is going to have its own account. Okay, and accounts basically is where the account is basically where we track. Where we track to what happens to each one of these elements. Okay, so this is it's a great slide to remind you what account falls under what category. What is an asset? What is a liability? What is equity? What are revenues and gains? And what are expenses and losses? Okay, and remember that revenues and gains and expenses and losses are actually part of that stockholders' equity in that expanded accounting equation because revenues minus expenses, that is what gives us our net income. When we talk about accounts, we are going to call it a T account. Okay, because basically we can draw a T and write the name of the account above it. And this is how we're going to track what is in each account. Okay. When we start talking about accounts, when we're talking about the left side of the T, whatever we put on the left side, if we were going to make an entry into this account, if we were going to go on the left side, we would call that a debit entry. Okay, if we were going to go on the right side, we would call that a credit entry. I cannot stress this enough, that all it means is debit means left side and credit means right side. This is where a lot of students run into trouble because they want to think debit means it decreases. Well, not always, okay? And they think credit means it's going up because we're crediting it, we're getting more of it. Not always, okay? There's a way we're going to work with these. It's just important to know that debit means the left side and credit means the right side. Okay? So debit and credit procedures. Using the accounting equation, we can incorporate debits and credits in a 3-step order. Okay. So you can draw a T account. Okay. And label, we have our debit side and our credit side. Step 2 is determine the normal balance of an account. So once we analyze our accounts and we see what 2 accounts that we're going to have. Okay. And then we know if they're going up or they're going down. Okay. That is our first kind of step there. And then we need to determine the normal balance of an account. All accounts have a normal balance. And what is meant by normal balance? It is what side of the entry do you need to make a left side entry, a debit entry, or a right side entry, a credit entry to make that account increase in value. Okay, and then the opposite is true. Okay, if a debit makes it increase, if we make a debit entry, if we put it on the left side of that account, it makes it go up. If we put it on the right side of the account, it means it's decreasing in value. Okay, so that's why we step through, we increase or decrease the account based on the normal balance. Now, this isn't in your textbook, but this is an acronym I learned in school, and I think it's very, very helpful. It is called DEALER. Okay. So the first DEA, if you made your T account here on the left side, dividends, expenses, and assets have a normal debit balance. Which means if we have a transaction happen and we receive cash, cash is an asset. Our asset is going up, so we would make a debit entry if we want to increase cash. Whereas if our cash was going down, we would make a credit entry. The final L, E, and R stands for liabilities, equity, and revenues. They have a normal credit balance, meaning that when they go up, we need to make an entry onto the right side. Okay? You can see how this is maybe going to keep us straight here. Okay. So say we sold goods for $5,000 cash. Okay, well, we are going to increase our assets. Little things happen here. Let me check my connections. Start my video back up. Still looks like I'm getting sound, which is good. Okay. So as I was saying, if we receive $5,000 cash for goods sold, okay, we would increase assets. So we would need to make a left-sided entry here because our assets went up. We would also increase our revenue. So we would need to make a right side entry over here. Okay. So it's very important to learn which accounts are assets, liabilities, equity, revenues, and expenses. And then after you can identify that, the next thing that needs to pop in your mind is what is the normal balance of this account? Which side entry do I need to make in order to make that account increase or decrease? Just remember the normal balance is the side that it's on that makes it go up. Okay, so here's kind of a summary. Assets, Debit makes the value of that account go up, and credit makes it go down. Okay, it is a normal debit balance. Whereas liabilities are a normal credit balance. So if they go up, we make a credit entry. If they go down, we make a debit entry. Okay, equity has a normal credit balance, meaning goes up on the right side, down on the left side. And then this kind of goes through breaking down, the retained earnings, the dividends and stuff like that. But really, if you remember this acronym here, dealer, remember dividends, expenses, assets, normal debit balance. They go up with debit entries, down with credits. Liabilities, equity and revenue, and normal credit balance, meaning they increase with credit entries and down with debit entries. Okay, so now let's check. What type of account is prepaid rent and what is its normal balance? Prepaid rent, rent is an expense. And it's prepaid here, so that is a prepaid expense. Prepaid expenses are assets. So you have an asset account. And if you think of dealer, assets have a normal debit balance, meaning that when we increase that account, we make a debit entry. Okay. So now we've analyzed our accounts. We've seen what specific accounts we're dealing with. We know whether they go up or down. The next thing we need to do is put it into a journal. Okay. The journal. This is the original book of entry. This is the first time that something actually gets recorded in the accounting system. Okay. It goes in chronological order. So that way somebody can come in and look at the books and they can say, what happened on this date? Okay. And whatever kind of financial transactions happen, it's listed by date in chronological order, and it's showing what is happening to these accounts. Okay. We're gonna have at least one debit entry, one credit entry. Okay. The debits and the credits have to balance out in order to make our accounting equation true. Okay. The three parts of our journal entry, whenever we go to record our journal entry, we need to have the date of the transaction, needs to be listed, the accounts, and the amount to be increased or decreased. Okay, so like I said, we're always going to have at least two. It could be possible that we have more. Okay. Our debit entries always get entered first, and they are flush to the left side of our screen here. And our credit entries always get entered on the next line. Okay. So on January 1st, Luigi purchases $3,000 computer from Worst Buy Electronics on credit, with payment due in 60 days. The first thing we need to figure out, we need to analyze the transaction. What is going on here? So we purchased a computer. So we are receiving equipment. Okay. Equipment is an asset. And it says we bought it on credit, meaning we owe money later. Something we owe, that is a liability. So we are increasing assets and we are increasing a liability. Next, we need to think, what is our normal balances? Okay, how do we increase an asset? An asset has a normal debit balance, meaning we need to make a debit entry to record that, to make it go up. In contrary, the liability, the accounts payable, is a normal credit balance. So if we wanted to make it go up, we would need to make a credit entry. Okay, so we were going to journal this transaction. It would look like this down here on the bottom. We would have our date, the account and explanation, equipment. Debits are always listed first, okay? And it's going to be butted up against the line. Imagine if they have lines right here for the date, the account explanation, the debit and the credit. It's always butted up against there. And we indent our accounts payable, through 3 or 4 spaces, just to note that it is a credit entry. And then we would have a debit column and a credit column for $3,000. Okay. Just to reiterate this, the date of the transaction is entered in the date column. Debits are always entered first and flushed to the left. Credits are written below the debits and indented to the right. Total debits must always equal total credits. We always have to balance that out. Debits and credits must be even, because that keeps that accounting equation intact. This says an explanation may appear beneath the credit, but in everything I'm going to have you do, you can omit the explanations. And they're not required in your homework assignment. As an accounting instructor, I can look at your debits and credits and I can tell what you think is going on there. Okay? In the real world, you're going to enter this in a computer and you'll probably type a little short explanation in there on what happened. Sometimes there is more than one. There can be more than one entry or more than two entries. Okay, there may be more than one debit or more than one credit. So for an example of that, we purchased a $3,000 computer. We paid $1,000 in cash with the remainder due in 60 days. So we have an asset increasing. Okay, our equipment, because we are receiving a $3,000 computer, is definitely increasing our assets. We are having some asset go down. Okay, because we are paying $1,000 cash, so we are losing some of that asset. But the remainder is due in 60 days, so we still owe $2,000. So we have created a liability here because we owe something. So if we were going to, and here's this kind of showing that assets went up by 3,000, down by 3,000, plus 2,000 over here. So you can see our assets total changed by 2,000 and our liabilities changed by 2,000. So we need to keep track of each account individually. When we go to enter it, again, we put our date in the date column. We start with our debits. So the equipment is an asset increasing, normal debit balance. Okay. So we have equipment. We would debit it, make a debit entry for $3,000. And that's it for the debits. Cash is also involved in this thing, but it is going down. It has a normal debit balance, meaning if it goes up, we put it on the debit side, but in this case, it's going down. So we will make a credit entry to cash for $1,000. And then accounts payable, that is that liability we were talking about up here. The liability increased. Liabilities, when we owe more money. Liabilities are a normal credit balance. So we need to make a credit entry to increase that liability. So we have equipment for $3,000 on the left, cash and accounts payable, that total $3,000 on the right. And it's a 3 account entry because 3 accounts were affected by the specific transaction. Okay, as you can see, our debits and our credits do balance. Okay. So now you're going to need your slide handout again. I want to show you something. In the Canvas page, up here you have a journal sheet here, T accounts here, which we're going to get to next, and your trial balance here, all is PDF formats. You can print those out if you want. You'll be able to write this stuff in like I'm going to do in a little bit. Or here, it gives you one of each all-in-one document that is in Word format. So you don't have to print them out. You can just, type straight into them while you're on your computer and practicing. That's what I'm going to pull up right now. I'm going to download this. And I'm going to show you what our general journal looks like. This is our general journal. As you can see, we have a date column. We have a description column. This is where we're going to put our account titles. The PR, that is called for a post reference, which we're going to talk about here in a minute. This will be our next thing after we get done with journal entries. Okay, posting it to a ledger. You're not going to use that at all, but you'll see that in the journal. Then you have a debit column and a credit column. Okay. So I am going to write from our chapter 2 slide handout page. We are going to go through these one by one. It's the same thing we did when we were analyzing the transactions. Okay, but now that we have them analyzed, we are going to put them into our general journal. Okay, these are also on your slides. So if you need to go back and review them, you can look through the slides on this. Okay, but instead of just showing you the journal entries on the slides, I think it'll be more profitable if I actually write them up here as we are working through them. Okay, so for our first one, on March 1st, High-Tech sold 1,000 shares of common stock to several investors for cash of $12,000. We already talked about what the effect of the accounting equation was. Yeah, but what's our accounts here? So we have cash, which we are receiving. We said our asset was going up. And also we said equity was going up. Okay, so let's go and journal this. We'll tell this on March 1st. So the first thing we need to do is we put our date in 3/1. You know what's happening? An asset is increasing. What kind of asset? Cash is the asset that is increasing. If you remember dealer, when assets increase, it is a normal debit balance. So if we wanted to increase our cash, we would write it first because debits always come first. We write it flush with that line over there. And the amount we put into the debit column of $12,000. Well, what happened here? Our equity also went up. But what kind of equity in this? This is contributed capital. Our account for this one will be common stock. We have issued more common stock. There is more common stock out. The value of the common stock is increasing. Equity has a normal credit balance. So to make it up, make it go up, we need to make a credit entry. So we would abbreviate a little bit and we would put common stock. We credit it for $12,000. And that is the journal entry for number 1. Number 2, on March 2nd, High-Tech raised additional funds by borrowing $3,000 from the First Third Bank of Cincinnati. High-Tech promised to pay the amount borrowed plus interest. All right, so first let's write our date on in here. One thing I should mention, notice you only need to put the date at the very start of your journal entry. Okay, you do not need a date on each line. It's only on the very first one. That indicates a new transaction is happening. Okay, you can't have multiple dates. If there was multiple transactions on March 1st, you could have multiple 3/1s on there. Okay, if two things happen that day that could not be put into the same journal entry. All right. So what is going on in number 2? So we raised additional funds. They borrowed $3,000. So cash is increasing. And they borrow money from a bank. So that means we have a note payable. We have something that we got from the bank with an interest component that is considered a note, a loan. We call that a note payable. A note payable is a liability. We owe more money. That is also increasing. So now we take our normal balances. An asset going up, in this case is cash, is our debit with a normal debit balance. Cash of $3,000. In debt for our credit, and we have a note payable, which is a liability. And a liability increasing because we owe more money is a credit entry. Okay, so we have a note payable for $3,000. Number 3, on March 3rd, High-Tech purchased office equipment from Metro Inc. for $4,500 cash. In this case, we have an asset, our office equipment. We are receiving more, it is going up in value, but we also pay cash, which is an asset, but it is going down in value. The amount of cash we have, this is going out of the company. So for this one, we would go 3-3. Equipment is our asset that is increasing. To increase an asset, it has a normal debit balance. We make a debit entry for it. 1,500. But cash is an asset, but cash is going down this time. See, in 1 and 2, when we received cash, we made a debit entry. Now we're paying cash, so cash is decreasing in value for the company. So to make it go down, we need to make a credit entry because it has that normal debit balance. 4,500. Okay. On March 4th, High-Tech purchased 6-month insurance policy for $1,200 cash. The effect on this was what? So we purchased a 6-month insurance policy. Insurance is something that is a normal cost of business and a normal expense. But because of the expense recognition principle, we cannot make it an expense yet. Instead, we have to record it as an asset. So we increased an asset in our prepaid expenses, or in this case, prepaid insurance. But we've also lost an asset because we had to pay cash. From 3.4, to increase the asset is the debit entry. We have prepaid insurance. In the amount of 1,200. And again, cash was paid, so our cash is decreasing. So it requires a credit entry for $1,200. Okay, number 5, High-Tech purchased office supplies for $6,500. They agreed to pay in 30 days. Okay, so here we are increasing an asset. We are receiving supplies. Okay. We're going to increase an asset. We need to make a debit entry to that asset. But we did not pay cash this time, so assets aren't decreasing. Instead, we promised to pay later. That creates a liability. Okay, there's no interest in this. There's no formal like signature type thing. So we're not going to call it a note payable. This time we're going to call it an accounts payable because they sold it to us on an account. We'll put our date in here. We jump to the 6th. We debit our supplies because our asset of supplies was going up for 6,500. We also increased this liability. Liabilities with a normal credit balance are increased with a credit entry. So we would do a credit to accounts payable for the same amount. Okay, number 6. On March 10th, we provided advertising services to Miami Valley Products in exchange for $8,800 in cash. Right, so we provided a service here and we received cash for it. So when we're analyzing this transaction, we notice that our assets, or specifically the specific account's cash, is going up. And since services were performed, that is called revenue. Think back to our dealer, R is the last R, or revenue is the last R in dealer. So we are getting more revenue. We want to increase our revenue with a debit. We're getting more, or a credit, increase revenues with a credit, a normal credit balance. We are also receiving cash. Our cash is going up, which is an asset, as a normal debit balance. Okay, so at 310, we list our debits first. Our cash is increasing. And revenue is increasing. We got more of a normal credit balance. We make it our credit entry in the amount of 8,800. Okay, so now on March 15th, provided advertising services to the Cincinnati Times, and we agreed to be paid later. Okay. So here we have already performed the services. Okay, so anytime we perform services, we actually do the work, we are getting revenue again. So if we wanted to increase our revenue because we did more work, we'd have to make a credit entry. Here in 7, though, they have not paid us cash like they did in our last example. They have promised to pay us later. When somebody promises to pay us later, that becomes an accounts receivable, which is also an asset. We need to increase our accounts receivable, so we will do that with a debit. And we need to increase our revenue again, which we will do with a credit, because that is the proper normal balances of those two accounts. We put our date, 3/15. We have accounts receivable, and we have service revenue. This time it's in the amount of 3,300. On March 19th, we received $9,000 from Metropolis News for advertising to be completed in the next 3 months. So here we got to perform a service. We receive cash, so we know that our cash is going up. Okay. So I'm going to go ahead and write that on. Cash is an asset. We received $9,000 in cash. But we have not performed any services yet. We are supposed to do them in the future. Okay, so according to the revenue recognition principle, we cannot record service revenue at this point in time. Okay, instead, it becomes something we owe. Okay, we owe this advertisement at some point in the future. Whenever we owe work or we owe product later, that becomes a liability, which is called unearned revenue. That is a liability account. The liabilities are the L in dealer, which fall as a normal credit balance. So since we owe more work in the future, that account is increasing. We make a credit entry to it for $9,000. Right, so on March 23rd, we pay $6,000 cash from the supplies previously purchased from Hamilton in transaction 5. Okay, so now we're talking about in this here, on the 23rd, we are making a payment to them now. Okay, at this point in time, we are paying cash, right? So our cash is going down. An asset decreasing is a credit entry. But also, we determine when we analyze the transactions, that now we do not owe them as much money. So what we owe is also decreasing, or our liability is going down. Okay. So when we created the liability right up here on 3.6, we created an accounts payable for $6,500. Now we can do a debit entry to make that account go down. Accounts payable for $6,000. Okay, because up here we were saying we owe them $6,500. Down here we paid $6,000, so we can reduce that $6,000 from our liability. We really only owe them $500 more now. Okay, and cash is how we got it to go down. We lost cash from our business to decrease an asset. We make a credit entry for $6,000. On March 25th, we collect $3,000 from the Cincinnati Times for services sold earlier on credit. So now we're talking about this one right here. We did some service for them, so we got our revenue of $3,300, but they owed us that money. Okay. When we analyzed this transaction, we saw that an asset was increasing because our cash is going up because they paid us, but also an asset is decreasing, that accounts receivable. which keeps track of how much people owe us. Well, now they do not owe us so much, so it is going down. So for this journal entry, we put our date, 3/25. Cash and asset is increasing, gets the debit entry for 3,000. And now we can lower the amount of our accounts receivable because those people no longer owe us the cash. Okay. And as you can see here, even though they're paying for services, we already recorded the revenue, which is the value we get for services performed and received. So we don't want to double record it here. Just want to think, we've already recorded the revenue, they're just paying us for something we already did, so they no longer owe us, which allows the receivable to go down. Okay, so on 3/26, High-Tech paid weekly employee salaries of $1,800. Salaries, that is an expense, and that is a normal cost of business. Expense is the first E in dealer, which means it has a normal credit balance. Okay. So on 3/26, we have a wage expense. Okay, or it could be called salary expense. In this case, it does say salary, so it might be better to call it salaries. But salaries and wages, kind of the same thing here. In the amount of $1,800. We paid it in cash, so cash and asset is decreasing. So with a normal debit balance on an asset, to make it go down, we need to make a credit entry, $1,800. Okay. And finally, number 12 on our sheets here. On March 30th, High-Tech paid utility bills of $5,200. Okay, it says paid, so that means that cash went out. Cash being an asset going out means our cash account is going down. We have less cash in the business now, so that is a credit. Paying utilities, utilities are a normal cost of business. So again, that is an expense. An expense being a normal debit balance. We will do our debit entry first. Utilities expense. Credit cash, we're going out in the amount of $5,200. Okay. And that is how we make journal entries. Okay. I have two handouts where we're going to do more journal entries, and this is basically what we are going to be doing all semester. We are going to be making journal entry after journal entry after journal entry. So that's a lot of what accountants do. They have journal entries made, you need to understand how they're getting in, and then we'll go back and look through them to make sure we're getting it right, okay? But this is the first place where stuff gets recorded. As soon as the events happen, they get put into this journal in chronological order and the date that they happen. Remember, debits always get listed first, credits come second, they're embedded a little bit. You need to analyze the transaction, figure out the accounts that are being affected, whether those accounts are going up or down. Recognize the normal balance of the accounts by using the dealer acronym. Remember, dividends, expenses, assets, normal debit balance, liabilities, equity, revenues, normal credit balance. The normal balance is the side that makes it increase in value. And we're flying through these. So I went back to the beginning. I thought it would just start me off where I was. Okay. So if you need to look through these, you have a handout, you can watch a video. If you don't want to go through the whole video again, you can go to the slides here, and it's going to show you here exactly what we did for each of these things. Okay, so that'd be a good review for you. You can just look through the slides. Okay, so after stuff is entered into the journal, the next step is to post it to the ledger. Okay, the general ledger is the second book of entry. And what it is, it just has its chart of accounts. Each account has its own page. Okay, we refer to these as T accounts. Okay, so you would look at what was in the journal and then you would move them into your T accounts. You saw it to be a little bit better, okay? So like for everything we did here in those transactions, look at our, whoops. So look at our cash account up here. Okay. We make a T. And we write cash above it. Okay. Anytime that we made a debit entry, we would put it on the left side of that T. So in transaction 1, our cash was debited by 12,000, so it goes on top of that. In transaction 2, you can see our cash was also debited, so it goes on the left side. In transaction 3, we paid out some cash. We made a credit entry to our cash account, so we put it on the right side there of the T account. Okay. When we get all done, we can take it out and we can figure out how much is in the account at the end of the period. Okay, and that's going to help us make our financial statements. As you can see here, our cash ended out being $16,600. The normal balance of that account should be, the value should be on that side when you go to finish the account. Okay, our cash cannot have a negative value. We can't spend more cash than we have, so it can never have an ending credit balance because it is a normal debit balance. One of the things we talked about was our liabilities. All right. Remember I said that, well, we had 6,500, we paid 6,000 of it off, we have $500 left. Well, if you look at our liability T account, our accounts payable was the first one. We put 6,500 in it in transaction 5. Okay, when we bought those supplies. In transaction 9, when we paid the supplies off, as you can see, we lowered the amount of our accounts payable, which leaves us with $500 credit balance. Liabilities are a normal credit balance, so it means we still have $500 left to pay. The reason why we posted these T accounts is in order to keep track of each of these accounts individually, because these accounts are what's going to go onto our income statement and into our balance sheet. So that way you don't have to dig through the journal all the time when we're going to make statements, you know, and then try to figure it out, because the journal is in chronological order, easy to go back and look at and see what happened on this date, what happened here, you know, if somebody wants to come in and look at that. Whereas the general ledger keeps track of each individual account. So if somebody wants to come in and see what's happening with cash, they can come in and just look at the cash account. They don't have to look through all the general ledger and pick out what happened with cash, because it's going to be littered with other things here. Okay. Finally, step 4 is to prepare a trial balance. The trial balance is kind of exactly what its name says. Okay, so first it's a list of all the active accounts. What we mean by active accounts, it's any account that has an ending balance. So if we look back over here, every one of these accounts has an ending balance somewhere on it, right? Okay. If, for example, we would have paid off all of the accounts payable, and it had a 0 balance, we would not need to put that onto our trial balance. So we're only going to list the ones that have a balance. Okay. they're going to be listed in a specific order. They are going to go assets first, then we're going to list our liabilities, and then we're going to list the equity, then dividends, then revenues and expenses. So you would write them all out, and then you would enter their amount, whether it was a debit amount or a credit amount. Okay, so we have all our accounts here. We start with all our assets. Then we have our liabilities. Then we have our equity account, then dividends, revenues, and expenses. Okay, listed of what their ending balance was from the T account. Okay, all of these are coming from the T accounts. That was a few slides back. We just pull those numbers over, and then you add up all your debits, you add up all your credits, and they should balance each other. That is why it's called a trial balance. We are just double checking ourselves to make sure everything got entered right. Not only making sure it got entered right, make sure it got posted right, that it got pulled from the ledger or pulled from the journal into the ledger at the right amount. Make sure no numbers got transposed. It's easy to do, you know. Instead of putting 1,250, maybe put 1,520 in one of the accounts. Figuring it over there, human error is possible. This trial balance is going to help you catch those. If it's not balanced, then you can go back, match up your journal entries again with your T accounts or your general ledger and determine what went wrong. Okay. Accountants record transactions first in which of the following? What is the book of original entry? That is our journal. So after we analyze it, we record it in a journal. From the journal, we post it to the ledger. From the ledger, we make a trial balance. Okay? And that is what this is why this is one of the most important chapters, is because this is what we're going to be doing all semester. Okay? We are going to be posting stuff into our journal or journalizing transactions into our journal, posting it to the ledger, figuring out the ending balances, making adjustments, doing other things with them. And it's very important that we understand journal entries. That's why I have 2 handouts on journal entries that we're going to look at in the next 2 videos. And also just remember on the sheet here, you also have a sheet here where you're practicing where you have T accounts already made. And you can just write the name above it, and when you're posting it down, it's left hand, right side. Okay, and you also have a sheet here for your unadjusted trial balance, where you list your accounts in the proper order, and list where there are debits and credits, and then total them up at the bottom. So that is it for this lecture video. If you've done this, go back now and let's do some practice with chapter 2 handout 2 and chapter 2 handout 3, and then you'll be all ready to do your homework assignment for this chapter. Talk to you again soon.